clarification. How do we go about handling that, Hank?
Okay, Peter, normally the way I deal with, and I thank you for that input there, is that, and it's quite right. I normally allow you first to do the presentation, and then I will request if there are some of the students that do have questions, they can either at this point write it down there in front of them, or they can make use of the chat box or chat with everyone there on the right hand side, and they can post their question. I will monitor that. But I think first we want to give you the opportunity to do for us the presentation, like in a conference kind of mode.
Yeah.
And then once you've done that, then we'll give time for question and answering.
Wonderful.
All right. So guys, I have started recording. I hope everybody is okay with the recording of the session. So we can also make it available to those students that might not be able to attend this evening. So first of all, welcome to all our students. Also, welcome to Rihanna and Brian. These are two lecturers for marketing. Guys, again, I do appreciate your time that you spent with us. And then, ladies and gentlemen, I had the privilege to introduce to you tonight Peter Ivanov, quite a remarkable person. I've got his CV in front of me, and the first words was coming up is that we have absolutely a seasoned marketing specialist, and a person probably that have already walked the road, and I think it's going to be absolute pleasure to listen to him tonight and to hear about his experience. And that is the purpose of our sessions, is to bring a little bit closer the world of work and the world of academics. I just want to share a few things from Peter. Most important, he's the founding member of the Market Center South Africa. And I noticed that they have a various range of clients, which include Bidvest, Hollard, Guardbank, Absa, Vodacom, DStv, and Toyota, which already is a remarkable achievement to have those kind of companies on your books as consulting to them. You also have filled a number of very senior positions in a number of top companies, Sasol, Blue IQ, Astro Group. And then maybe some of you might still remember, depending on your age, there was an ad from Sasol. It was quite a while ago. It was called Alma Gluk Gluk. And some of you might remember that. And that was also the work of Peter. He was appointed by Sasol to lead the marketing team and to deliver the business outcome of a multi-million rand sponsorship of the South African Football Association and National Olympic team. Peter, I still remember very much that ad.
Yeah, yeah, no, exactly. It's a wonderful time. Wonderful.
Yes, it definitely have left a mark, I think, in a lot of people. And then also, Peter is professional registered with various associations. He have received various awards for his work that he has done, and also have done publishing in terms of the word. Peter, thank you very much for this opportunity. I'm handing over to you. Guys, you need to sit back, relax, and really enjoy the presentation.
Okay, wonderful. So welcome, everybody. I'm glad to be here. This evening, I want to talk to you about measuring marketing or marketing measurement outcomes. This is a very important process. And what I want to start off with is that there's a critical issue that's happening in marketing right now, and that is marketing has to become more accountable for all the things that it does within the business environment. You know, I often say to people, when you walk into an organization, every single person in that company, irrespective of who they are, is responsible for the marketing outcomes of that business and of that organization. And it's all about that marketing accountability. At the end of the day, marketing has got to produce a return on investment in terms of physical numbers. So consequently, it's about accessing the productive outcome of marketing, both in terms of financial and in terms of non-financial metrics that boards of directors and shareholders alike want to see. They want to see exactly how this process of marketing actually works within the business environment. So measuring the productivity of marketing is really about assessing the contribution marketing makes to the overall organizational financial performance, which is actually measured by the EBITDA or EBIT outcome process. Now, that's all about earnings before interest and taxation and so on. But it's very important that you as marketers start to understand what type of impact marketing would have on the financial contribution process. Now, hopefully in the course of the next hour or so, I will elaborate a little bit more on some of the measurement processes that we manage and why it's so important to look at these issues as a contribution to the business. So, there are a number of critical factors that we look at, or popular factors that we look at, when it comes to evaluating marketing performance measurements. And some of them, for example, revolve around market share. Now, brand market share is an incredibly important outcome when you start to look at the total size of the market. Now, some of you may have heard of the word TAM before. TAM refers to the total addressable market. Any market that you're working in, any market that you're selling in, you have a total addressable market that you can market to. The fundamental question here is, how big is that market? Is it worth 100 million, 200 million, 300 million, a billion rand? Whatever that number is, you will have a slice of that. And you've got to understand as marketers, what is my market share ratio of that total market? How much do we control? And where do we go in terms of expanding our operation to gain further market share? Now, this is so important. If you don't understand the size of the field that you're playing with, or the size of the cake that you have to divvy up, you're not going to be able to apply a lot of the other marketing metrics and marketing processes that you need to apply when developing the business. Okay, so brand market share and understanding your market share ratios is an incredibly important process. Following on from that type of activity, we then talk about lead generation. And lead generation is nothing more than new business development. But it's a slow, laborious process of developing leads. Often I see, and I'm quite fascinated by the number of one-hit wonders that I hear about, lead generation here, and we can do lead generation there, and it's so easy to do, and you'll have all these leads coming in. It's not exactly what happens in reality. It's a slow, laborious process. You've got to woo your customers. You have to build your brand in the mind of that customer. You have to establish your business credentials, etc., etc., etc. And that way you start to build your new business development process, and you then start to generate the leads. And in that process, incidentally, they have to be qualified. They either have to be qualified as marketing qualified leads, and then ultimately sales qualified leads. And there's a process and a value attributed to those elements. But as serious marketers, you really need to understand what is involved in that process, what is the outcome, and what are the cost implications of doing so. The very next point on this list here is customer acquisition, and specifically customer acquisition cost. One thing that we do know as marketers is that it will cost you 7 times more to recruit a new customer than it would be to retain an existing customer. And often a lot of businesses are so concerned about the pursuit of new customers that they forget to look after and retain their existing customers. And there's an absolute cost to that acquisition. Any customer that you bring in, there is a cost. And I will show you through the course of this presentation exactly what customer acquisition costs look like and how we calculate them. Following that process, of course, we then talk about customer churn rates. And once again, churn rates cost the business money. And I will take you through a typical customer churn rate calculation and how we look at this and why it's so important, and and the absolute rand values that are associated with customer churn. Now, a lot of companies, especially the telcos, will often talk about customer churn rates. Very few of them really attribute rand value to those churns, because in order to look at the rand value to a churn rate, you then have to understand what is the customer lifetime value, which is another financial metric that we look at. And once again, we'll get to have a look at those things. Then we have customer engagement. So all about, and you guys have probably heard the word before, share of voice. What is your share of voice in the marketplace? Once again, share of voice is costing you money. How much money are you investing to build your share of voice? What type of return on investment are we achieving as a consequence of that marketing spend around the share of voice? And of course, then we get into other softer issues around website traffic. So the ORS analysis that we're looking at there is all about your online ranking score. So how do you score in terms of your overall digital presence, the digital ecosystem? What is your outcome scores there? What are you measuring? How are you measuring your content? Do you measure your content? Are you deploying things like GNS or GNI, for example, from Google, to actually evaluate how well your content is actually resonating with potential customers and or existing customers? And there's a whole bunch of other things around the web-related activity and digital activities that we need to be measuring in terms of analytics. So you've all heard of Google Analytics, and then of course you've got Pixel on Facebook, but you also have other products like Shield on LinkedIn, where we can start to evaluate exactly what is going on and what sort of engagement and traffic and traction are we able to achieve. And then of course, at the end of the day, we want satisfied customers. So things like your net promoter score or customer satisfaction surveys are another issue that we then deploy. And there is a direct correlation between having a high positive net promoter score and having a high positive relationship with your turnover, your retention of your customers, and a lower customer acquisition cost. This we know, and there's plenty of research to support that narrative. And then, of course, we talk about customer profitability ratios. Now, whilst you might be spending money in acquiring new customers, it doesn't necessarily mean that that customer is going to be highly profitable. So you need to also be able to have a look and see, are these customers that we're acquiring actually profitable? Are they worth us even having? You know, sometimes we look as professional marketers, we look at our customer database, and we have to ask the hard question, how much of that database do we need to cull? And we need to do that because the cost of servicing is actually depleting our profitability. And I've seen that so many times, especially when you talk to sales reps, for example, and they will tell you, oh, they love going to see this customer. They're really so super nice. They have, you know, lovely coffee sessions, and they talk about the rugby or the football or whatever it may be. But at the end of the day, that customer spends very little money with you. And as a consequence of that, their profitability is virtually non-existent. Yet we insist that they remain on our books, and we insist on calling on them for what I do not know. You see, that's all about customer profitability ratios. And it's very important as marketers that you understand that. And I guarantee you that most businesses, nearly 80% of a company's revenue will come from just a mere 20% of their customer base. 80% of their revenue coming from a mere 20% of your customer base. That's called the Pareto principle. And it's been borne out over the course of time. We know this to be absolutely true. And it's something that younger marketers need to start coming to grips with and understanding what is going on within their customer portfolio and who's buying from us and how are we engaging with these people. So these are just some of the things from a marketing performance measurement criteria that we investigate and look at. And I'm just touching on this very quickly. As I said to you earlier on, this is a very it's a major subject, and it's a subject that takes quite a bit of time to really get a handle on. So what you're looking at on the screen at the moment is a measurement mapping, or customer experience measurement mapping tool that we use. So you can start at the very beginning, where we're looking at product research, where the customer first starts to engage with you, and there you start to measure share of voice. What is our share of voice against our competitive brands? How is our word of mouth panning out versus our competitors? What is our online presence like in that process as well? What is our customer per lead cost panning out at? Customer acquisition costs, marketing qualification lead processes. What is our pricing comparison ratios like by comparison to other competitors out there? And it's all of these little acronyms that we go through at each stage of the purchasing cycle to understand exactly what is going on. And each one of these has a direct meaning. And I'll show and elaborate on some of those processes. But suffice to say, there is an activity, there is a flow that happens in terms of that customer engagement and that advocacy process, from the awareness and discovery process that customers go through. And at each one of these stages, we can measure their outcome and measure their participation rates. Okay, so in terms of the measurement marketing pyramid, we always start at the very bottom, where we look at the metrics. And those metrics are the detailed actions that help us improve our efforts by using data insights at the end of the day. So what data are we going to be looking at? How do we apply a metric to that? Because that's going to become the very basis of the performance measurements that we would apply. Then, of course, and you've probably all heard about KPIs before, and this is the unique aggregated measurement process that we use that helps us shape our purpose towards the goals that ultimately we're trying to achieve. And we need to spend quite a bit of time really understanding what those KPIs are going to be. And are those KPIs in alignment with the overall business objectives and business plans? Because if they're not, then there's a disconnect between the two, and you guys, or us, generally marketing people, are going to be measuring and managing the wrong things. And our job is to assist in achieving the profitable and sustainable growth of the business at the end of the day. And that's why you need the alignment of the KPIs with the business outcomes at the end of the day. And then, of course, the goals. So that's the outcomes achieved in terms of revenue growth and profitability and overall brand equity. I think one of the most important things that I want to stress here is about brand equity. A lot of marketers forget that what we do in a lot of the work that we undertake is we build brand equity. Brand equity has a value, and a very meaningful value, to the point where, as you build your brand equity, that value can be attributed onto a balance sheet of an organization. So to give you some idea, if you look at Coca-Cola right now, the last time I checked, their brand equity value was positioned at about $92 billion US. So that $92 billion US is flagged and identified on the balance sheet of the organization. So if you went along to Coca-Cola tomorrow and said, tell me, what is the price of purchasing Coca-Cola on a global basis? They will give you two numbers. The first number they will give you is the price to buy all their bottling plants all over the world. And then the second price they're going to give you is the brand value, which is that equity value I've just mentioned. So over and above the cost of the actual hardcore machinery, you then would have to pay for the brand equity as well. And that's such an important key attribute that marketers bring to the table, the building of brand. And incidentally, quite recently, they've now brought out an ISO a measurement criteria around brand equity. If I'm not mistaken, I think it's ISO 20619, if I'm not mistaken. But they've gone to that nth degree now of having an ISO standard around brand equity value. And it's something that marketers are absolutely responsible for. Nobody else in the organization is responsible for brand equity. You are the brand custodians as marketers. And it's a very important discipline that we have to look at. Okay. So moving on from there, let's have a look at some of the marketing measurement metrics. This is in terms of revenue and profitability that we look at. So the very first one is customer acquisition cost. I mentioned that earlier on in my presentation, where we're talking about this measurement. We measure here we're basically measuring what an organization spends to acquire a new customer. That is referred to as the customer acquisition cost. It's a very important business metric when measured against customer profitability. So it's no good spending 10 Rand acquiring a customer when their profitability factor is only going to be 2 Rand. You get the point there. I mean, it's just ludicrous that you would spend 10 Rand to acquire a customer and they only produce 2 Rands worth of profitability. You just physically wouldn't do that. Likewise, we get into then price comparison ratios, or PCRs. This is a quantitative relationship between two or more pricing ratios. So competitive product pricing models can be used strategically to position the brand or compare within a particular market segment. So if remember, I spoke about the total addressable market. If you're trying to grow market share, if you're on a growth strategy, you might want to understand exactly what everybody else is charging for widgets A, B, and C, so that you can then strategically price your product a little lower than that particular margin in order to grow market share. So it's a market share acquisition growth strategy that you're pursuing in that particular case. But you need to be able to understand how we compare ratio-wise with all of the next 5 competitors that we may be dealing with from a pricing perspective. Likewise, the converse could also be true. Whereas we have got a very high price product and all our competitors are competing at the mid-price range. Once again, that is going to have a negative effect on market share growth and, of course, attracting customers to our particular organization. I mentioned customer churn rates. Now, this is the rate at which you lose customers during a specific period of time. It's measured in volume and value. So you could have a customer churn rate that's costing you 200,000 Rand a month. But most organizations don't even measure that. And it's a problem. If you're not measuring your customer churn rate, how many customers have we got at the beginning of the month? How many customers have we acquired? How many customers did we lose during that trading cycle? You've got a major problem, and you will have a problem. And you see all these organizations saying, "Oh, well, we just ran out of money. We didn't have enough customers spending money with us. That's why we got into financial trouble. That's why we've had to apply for bankruptcy. That's why we've had to lay off all the staff, etc." I guarantee you trace it back, nobody kept an eye on what was going on with their customer churn rates, and as a consequence, they weren't managing that particular process. And at this stage, I just want to mention just a little saying that I was taught many, many years ago. What you don't measure, you don't manage. And what you don't manage, you don't measure. And that is absolutely true. If you're not measuring something, you're not going to manage it. And if you're not managing it, you won't apply any measurement criteria to it. Now, if you're going to be a really great marketer in the future, and I'm sure all of you will be, you've got to get into the habit of measuring things. Because that's how you're going to be able to hold yourself accountable, your team accountable, but more importantly, how you'll be able to demonstrate to the board your worth. Okay. So then we talk about customer profitability ratios here, or CPRs. This is the difference between revenues earned and the costs associated with customer retention. Now, there's always a cost to retaining any customer on your books, but if they're not producing profitability, you're really going to have to ask the question, well, okay, how much longer do we hang on to these guys for, or do we just cut them free? And once again, as I say, it's a fundamental question that needs to be asked by every marketing professional out there. And then, of course, we get the big one, the return on marketing investment. So it's a metric used to measure the degree to which marketing contributes to overall company profitability. And once again, it's something that we've got to become incredibly comfortable with. And it's one of the reasons why I said that your new best friend in any organization has to be that financial director or that chief financial officer, so you can start to understand where they're coming from when they start to look at return on investment and profitable growth. Customer lifetime values, or CLVs. This is the total projected spend by a customer on your products or services over time. It's an important business metric because it also helps in understanding and modeling cash flow processes. If you understand exactly how many customers are staying with your organization and what their monthly, quarterly, or annual spend will be, you can get a better idea of what sort of cash flow is coming into the organization. And that's exactly what your FDs are looking at. What sort of cash do we have on hand? How is that cash managed? Where does that cash come from? Remember, cash only comes from customers. Okay? And people say to me, yeah, but what about investors' cash coming in? Investors are only going to invest in your business if they can see there's a direct correlation between customers spending money with you, because they want to see a return on investment. So they go hand in hand. It doesn't matter which way you look at it. At the end of the day, customer lifetime value is absolutely critical. Once again, a lot of organizations pay lip service to that particular issue. Average order value, AOVs. So this tracks the average amount spent each time a customer places an order. It impacts your revenue growth. It also impacts your cross and upselling opportunities and your share of wallet. It also allows you, if you understand this process correctly, it allows you to start running predictive modeling, okay, through machine learning type activities, etc., etc. One of the companies that does this very well is Amazon. Amazon tracks every customer spend in their organization to the point now where they've got their predictive modeling algorithms running so well that they can now post or send, or what they call a push order, to a customer without the customer even ordering anything, because they understand what the customer buys on a regular basis. And this they're doing in America all the time at the moment. So it's becoming more and more of an issue, understanding the average order values. Then, of course, we talk about, here's my ISO standard. It's 2671, I beg your pardon. So this is the brand equity value, or BEV as we refer to it. It's the value the company gains from a product with a recognized brand name. And there is, as I said, an ISO brand evaluation model that we're now using to evaluate brand equity. And then, quite honestly, it doesn't matter what size organization you are. You don't have to be a Coca-Cola to start managing and building your brand equity value, because whatever size organization you're in, your brand equity is still going to appear on your balance sheet if you're clever enough to make sure that happens. So market share ratios. So that's MSRs. That's about taking the company's sales over time and divided by the total sales of the industry over the same period. And that's where we look at the TAM modeling. It's also described as your share of voice. But really, market share growth and market share measurements are absolutely key critical as well in your overall planning process, and it affects things like churn rates, the type of spend you're going to apply, the brand growth that you want, etc., etc. Okay, one of my favorites, total shareholder value, or TSV. So this is the return generated over the financial year. So it's the sum or the total of the stock that has been returned to those that have invested in it. And this is typically in any organization, there's always an investor, a stockholder, whether it's the owner of the business or whether you are a listed company and have multiple shareholders. They're all looking at what sort of return is being generated over the financial year. And if there is no dividend, they're going to get quite upset about the fact that you're not producing any dividend and why. And that's when all the hard questions come in about what are you spending on marketing, why are you spending on marketing, why are you spending on these ads, etc., 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 when you're not generating any revenue over the course of the year. So that's quite critical. Okay, then we start to look at things like return on net assets, or RONA. So this is a ratio. RONA helps evaluate how effective a company is using its fixed assets and its net working capital. So marketers can have a major impact on this outcome metric. And I'll show you, I've got a slide here tonight where I'll show you how RONA has a major impact and as a consequence of what marketing does on the overall performance of the business. Net present value. Okay, so this is a profitability indicator that we use when making marketing decisions about long-term capital projects, and they could be long-term capital brand projects. For that matter, we may be investing in the brand and brand development over the next 3 years, and we use a net present value or an NPV calculation to establish exactly what our return on investment would be over that period. Break-even analysis, I'm sure you've heard of that before, and that clearly determines the number of units or the amount of revenue that is needed to cover your total business costs at the end of the day. Once again, as marketers, you should understand what your break-even analysis is. So if you're not achieving the numbers, it's probably because you're not really looking at the break-even analysis. You're not understanding that, and as a consequence, you're not managing it as well. Okay, EBITDA refers to earnings before interest, tax, depreciation, and amortization. It's a financial term that is well known in financial circles and used by all financial directors, and it's the overall financial performance of the business. This is the ultimate measurement of marketing's contribution to the bottom line. And you will see how we have a major impact on that. Net Promoter Score is indicative of a successful word of mouth, and it's a multiplier of all your marketing efforts. It supports customer retention and customer lifetime value. And really, Net Promoter Score is really, at the end of the day, where customers are quite happy to recommend your products, your services, or your organization to other colleagues, to other businesses, or to friends and associates that they know. And that's quite a personal indictment on your organization. Okay, some of the non-financial metrics that we also look at, and incidentally, that list of financial measurements that I mentioned now are not exhausted at all. There's a whole bunch of other ones that we look at, but in terms of the time that we've got this evening, I've just limited it to those. Okay, we got the ROSA framework, and this is a data-driven approach to developing actionable content insight using analytics. We've got things like cost per lead. I'm sure you've heard about that. It's a digital marketing pricing model that advertisers pay. It's a pre-established pricing for each lead generated. Online presence, which refers to all activities and content that a business has under its brand name on the internet. So it's ranking traffic, visitors, etc., etc. Website bounce rates, WBRs. So this measures the number of visitors that arrive at your site and leave without doing anything. It's an incredibly important metric when it comes to evaluating your website performance from a marketing point of view. And each and every page. So if you look at Google Analytics, it will often give you an overview of your website bounce rate. And it might be 70, it might be 50%, whatever the case may be. But each and every page also has a bounce rate as well. Now, one of the things that we can do when we start looking at bounce rates from a Google Analytics point of view, we can start to establish goals in terms of what we're trying to achieve in regards to the bounce rate. So if we get a bounce rate lower than 40%, we're doing pretty well. If you've got a bounce rate that's up in the high 70s or 80s, you've got a serious problem. And this allows us then to take corrective action. It allows us to look at the content. It allows us to explore and maybe do and conduct some social listening to find out exactly why we have such a bad bounce rate when it comes to copy that is not perhaps resonating with our customers that are coming to our site. Another thing that affects bounce rates, of course, is the speed of your website opening. Now, if you've got a website that's opening, well, at the moment, I think Google has said that their current bounce rate is 2.5 seconds. So the opening time. So if your website doesn't open in under 2.5 seconds, you're gonna have a bounce rate. So they say that if your website takes 7 seconds or longer to open, 40% of your customers would have bounced already. So it's a very important metric to understand, manage, and evaluate on a regular basis. Of course, then we have qualified leads. So the qualified leads are split into two categories. You've got what we refer to as marketing qualified leads and sales qualified leads. And it's as the prospect moves through the sales funnel, they convert into actual revenue customers. And there's different qualification processes that we put into play that determines whether they've been qualified by marketing and can be handed over to sales, and then how sales would qualify them further through the funnel process. Right, then we get into what we call customer response rates. So this measures the total number of customers who respond back to your company's communication efforts. Okay, and that could be linked to a call to action that you've put out there in the marketplace as well. But response rates are important in terms of understanding how our copy, how our content is actually resonating with folk. Then we refer to things like first-time delivery rates. It's a measurement criteria, so it measures that last mile delivery executed by the business in the first attempt. So delivery times, delivery rates are incredibly important. And some organizations, like if you were doing business right now with Pick n Pay, for example, they monitor and measure their first-time delivery rates. So if you're not delivering on time, they're going to start to penalize you. And they have clauses in their contracts that penalize you from a financial point of view. So you could end up losing all your profit just in fines, basically, because you haven't performed in terms of your first-time delivery rates. Okay, then we talk about first-time response rates. So if you've got call centers and you're interacting with customers on the telephone, your first-time response rates are incredibly important. It's the time it takes to respond to a particular customer inquiry. How quickly are we doing that? Some time ago, I remember organizations used to say, by the third ring, the telephone must be answered. It's that sort of attitude. But it goes a little bit further than that in understanding how we're responding to these customers. Are we solving their problem? And are we giving them a great customer experience? And then, of course, we move on to things like first-time fix rates. So if you're selling capital goods or capital equipment, and you're in an engineering environment, and you're doing installations or commissioning or repairs, first-time fix rates become incredibly important. And it's the percentage of time a technician is able to fix the issue with the client first time out without having to go back a second time. Now, once again, first-time fix rates are something that is monitored, and I've seen those deployed in a variety of engineering and capital sales settings where that becomes quite an important issue. And also it determines whether or not you're going to be retaining a customer or losing a customer. If your service levels are so bad, you could find yourself out of that business in short time. So then we get into cost per rating point, or CPR, used to measure the cost to reach certain percentage of our target markets and such. Once again, it's a measurement applied to that overall communication process. What percentage of the market are we actually reaching? What is the cost to reach that market, et cetera, et cetera. So now I want to take you through a typical customer acquisition cost analysis. So as we say here, this shows the marketers the money spent on advertising, salaries, and other things to acquire a customer. Keeping an eye on the cost, the customer acquisition cost is important, because if it gets out of control, it will have a major impact on profitability. So if we look at this diagram here, you can see we've mapped out the sales and marketing costs. That comes in at 165,000 Rand. We've looked at the social media costs that we've invested 12 grand on that. The PPC advertising costs, we spent another 8,500 there. Activation costs of a further 6,500, creating a total marketing cost of 192,000 Rand. The revenue generated as a consequence of that spend was 930,000 Rand, broken up as follows. So new customers that we acquired were 5,000. But in that process, we talk about customer abandonment rates. So we had 315 customers that didn't complete any transaction with us. Although we acquired them, although they came through the pipeline in the process, they didn't actually end up spending money. But we're tracking that, and we know that the churn rate on that volume of customers in this particular instance was 6.25%. So we lost 315 customers. So total orders that we received was from the balance of 4,685 customers, and the average order value there, as you can see, was 198.50 Rand. So when we then calculate the customer acquisition cost, we're taking the 192,000 that we spent on the overall marketing expenditure, dividing it by the total number of orders we received, which in this case was 4,685, and we get a customer acquisition cost of 40.98 Rand. So let's do a financial summary here on this particular process. So we've got the average order value of 198.50 Rand. We've got the cost of goods sold, because there's always a cost of merchandise, which was at 39% of the total value, which was 77.41 Rand, which gave us a gross profit of 120.09 Rand. Less the customer acquisition cost of 40.98 Rand gave us a gross profit margin of 80.11 Rand. So your gross profit ratio per order there is running at 40.35%, which is pretty good as an exercise. Now, in any customer acquisition process that you go through, you can apply the same modeling activity, and you can actually set KPIs and outcome goals that we want to achieve a gross profit ratio per order of not less than 35%. So anything above 35%, we're doing incredibly well. Anything below 35% is beginning to cost the business money. So these are things that you can measure and manage on an ongoing basis. So when any senior executive ever asks you, listen, you spent this 192,000 Rand, what did you get out of it? This is the way that you prove that process. We're able to sit down, run the calculations, and actually work out exactly what it costs us to acquire those customers and do that business. And very little argument would be had from any executive looking at numbers like this. Rihanna, I don't know if you want to comment at this stage at all. Hello?
Hello, Peter. Sorry about that.
No.
No, yes, I'm actually with you. And I think, what has been obvious for me so far is, and I know you've spoken about quite a few different measurements so far, is that even if you only apply at least 3 or 4 of these measurements and you understand them well, you would already have a much better handle on the different financial measurements and acumen that is taking place within your organization.
You're 100% correct. 100% correct. And thank you for your input there. Much appreciated. Okay, let's move on to another one then. Sorry. Let me just lost myself there for a second. Okay, so let's have a look at churn rates here. So this is what we refer to as churn rate modeling. And to calculate the churn rate, we begin with the number of customers in the database. So at the beginning of the month, you have a look at your active database and you say, well, okay, we've got 10,000 customers. So in this example, we're going to lose 500 customers. Okay. Sorry, I just want to get rid of this call. Sorry about that. So in this particular example, we're talking about losing 500 customers, or 5% of these customers, but we acquire 5,000 new customers throughout the month, of which 152 or 3% churn out, as I showed you earlier on. So the way we calculate this process is we calculate 500 that we've lost from the original database, plus 152 from the newly acquired customers, giving us a total number of 652 customers, divided by the original customer database of 10,000, which then gives us the percentage of 6.52% churn rate. So as you can see in the diagram there, you've got existing customer base, 10,000, churn customers, 500, newly acquired customers, 500, new churn rate there of 152, total customer base 14,348, churn rate of 6.25%. And so you can see in September, the same thing happens. We start with the database of 14,375. We have a churn rate of 719 customers. We also acquire another 5,000 customers. We have a churn factor there of 130, bringing the total to 18,526 in terms of our customer database. And our churn rate there is 5.9%. Now, the reason why we're evaluating these churn rates, because we wanted to also establish a KPI. So any churn rate above 9% is cause for concern. In this particular example, you can set whatever churn rate you want, but 9% is an example that we would typically use. And just to give you some sort of impact financially on this, you got 652 customers with an average order value potentially of 1,252 Rand. That gives you a total amount of 816,000 Rand. So when you then look at it in terms of your newly acquired customers who are spending an average order value of 186 Rand, for example, that gives you a total revenue income of 902,000, which when you deduct what you've lost from what you've gained, you end up with positively 86,000 Rand. Is all you've gained at the end of the day. So it's incredibly important, and I can't stress it enough, that we start to understand what's happening in terms of our customer churn rates and what the financial impact of that would be on the business. This is a marketing return on investment, or a marketing profit and loss sheet. And a marketing P&L is a statement that summarizes the cost associated with various marketing initiatives. The marketing P&L doesn't differ very much from a traditional profit and loss account. It is comprised of the same set of items like revenue, cost of sales, gross profit, gross margin, customer acquisition costs, which is purely a marketing element, operating profit, and your EBIT. So if we look at this model here, once again, we can start to examine what revenue did we achieve in that month or that quarter or whatever period you're looking at. And in this particular example, we've achieved 930,000 Rands worth of revenue. There's been a cost of those goods sold, and that cost of goods was 362,700 Rand, which then left us with a gross profit margin excluding the marketing costs of 567,300 Rand. As we cascade through this, you'll see that there's marketing costs that we deduct of 192,000, which then gives us a gross profit margin, including marketing costs, of 375,300 Rand. So our margin, our top line margin number there is 40.35% is what we've actually achieved. Then we break that down into the customer analysis. So customers acquired were 5,000. The average order value was 186 Rand. The cost of goods sold to that was 72.54 in this example, less the GP per customer, less the cost of goods sold, gave us a figure of 113.46. The customer acquisition cost was the 192 by the 5,000, which was 38.40, leaving a total gross profit per customer of 75.06, which is the 40.35%. So we're balancing there in terms of what we've achieved vis-a-vis customer acquisition. But there's one other factor we have to look at in this P&L, and that is our churn rate. So the value of the churn rate is 652 customers times 186 rands gives us 121,000. So when we can conduct the summary, the P&L summary of this marketing expense, we've got revenue less cost of goods sold, which gives us that gross margin of that 567,300. Less our cost of our marketing, less the cost of customers that have churned out, which is 121,000, gives us an EBIT number of 253,573 rands. That's what the business has actually made in reality. 27.62% overall gross profit ratio. And once again, you can see how it's been diminished as a consequence of customer churn, expenses, etc., etc., etc. All of these factors make up a typical marketing P&L. Now, once again, if you're sitting down with your FDs or you're sitting down even with your chief executive and you're going through these numbers, they're going to understand exactly the type of value marketing can bring to the table, the type of interpretation and the type of understanding from a financial measurements point of view that we can put on the table in terms of return on marketing investment. And that's in essence what we're trying to do here, is demonstrate what marketing brings in terms of these investment processes. Okay, the next one we move on to here is customer lifetime value modeling. And once again, this is all about looking at how we value our customers and how we look after those customers and how we understand how valuable they are to us as an organization. And in this particular formula, what we do is we calculate exactly what a customer is worth on an annual basis. We then determine how long typically a customer is retained by the business. In this particular example, it is 5 years. And that has been achieved as a consequence of looking at the data insights and our loyalty card insights in this particular business application to understand typically how long a customer remains with us. Plus, we can analyze from our customer spend what the typical average value is that they spend on an annual basis. So when you start to multiply these things out over time, you can see that the overall retail sales revenue value is at 67,000 Rand. Then we go the lesser cost of goods sold, which is typically what we look at to get onto our gross margin. You can see there we've got a figure of 39,000 Rand gross margin. There's a cost of customer retention that's deducted from that. In this particular case, we used a marketing retention rate of 7%, which is 4,700 Rand that's deducted. So overall, in this particular scenario, each and every customer that we keep for 5 years is worth 34,000 Rand to the business. Now, over time, if we take our normal churn rate at 6.25% year on year, our total customer base over a 5-year period would be worth 19.6 million Rand to the organization. Now, once again, I can't stress enough that when you start looking at this type of modeling and you're putting these numbers to your executives, they completely then get why it is so important to invest in marketing, to invest in customer acquisition, to invest in everything you're doing from a marketing point of view. Because every single question you're answering with a financial number here. Not, oh, here's our great new campaign, or this is the wonderful new colors for summer. We're actually talking a financial language. And as marketers, the best thing that you can do is to talk to your colleagues in terms of financial numbers. They get that. Okay, so the next thing I want to share with you is the return on investment. And I'm conscious of time here, so I'm going to go through this as quickly as I can. The objective here with the RONA calculation is to achieve more sales at a lower cost using fewer assets. And this step-down process actually explains exactly how we calculate the RONA model. But I've got another slide here that might give you a better insight to how we do this. So this is a typical RONA calculation and a RONA outcome, where marketing has a massive influence on what happens in terms of overall profitability and outcomes in terms of the financial revenues. So in this particular case, we're looking at 2020 versus 2021. In 2020, we had sales of 9.2 million. In 2021, as a consequence of what marketing has done in terms of acquiring new customers, we've increased that to just over 10 million. So along with that whole process, we've also had a critical look at our overall marketing expenses. And from a marketing point of view, we have improved our packaging costs, and we've made major improvements with our distribution costs. Now, we've managed to save quite a bit of money there. So in 2020, our overall costs of goods sold was 4.8 million. We've been able to bring that down by adjusting our packaging and distribution down to 4.2 million. So the gross profit process there has increased from 4.3 million to 5.8 million. So that's 1.4 million that we've been able to gain as marketers, directly contributing to the bottom line here as a consequence of actions that we've taken, boosting sales, improving our packaging costs, improving our distribution costs. Then we look at the overall total expenses. And once again, we look at the reduction in operating costs by reducing inventory levels. So we may have had a whole lot of old stock, and we reduce that stock and we get rid of it by marketing it down and selling it off for whatever price we can get. And as a consequence of that, we reduce the overhead. So from 1.7 million down to 1.6 million, which gives us an EBIT profit margin going from 2.8 in 2020 to all of a sudden 4.1 million in 2021. So we've got profits on the one hand of 2.6 plus 4.1 in 2021, and sales of 9.2 versus 10 million. That gives us an EBIT margin, okay, from going from 28.2% up to 41.76%. So you can see how marketing has made a direct contribution to the overall profitability as a consequence of what marketing does within the business. Now, when we start to calculate the EBITDA number, we then take the sales divided by the total assets. Now, as you can see here, you got sales of 9.2 million and an asset base of 9.3 million versus 10 million in sales at an asset base of 8.2 million. Bearing in mind, we were able to reduce that because we got rid of a whole lot of stock. So all of a sudden, our asset turnover improves from 0.9 to 1.21. Now, when we then multiply our profit EBIT margin at 41.76 with our new asset turnover rate, all of a sudden we get a RONA calculation at 50.52. Now, any investor coming into any organization, when they start to see RONA rates like that and turnarounds like that, they're going to be only too happy to make sure that marketing gets what they want at the end of the day. And it's a very important process to learn. Now, I know I've skipped over this quite quickly. It is there's a lot more to it than what I've just told you there, but it's certainly worth investigating RONA and understanding how we get to grips with that as marketers. So moving on from there, of course, with all these numbers, with all these calculations, with all these measurement processes, we can then sit down and develop a detailed marketing dashboard. And this is just an example where in this particular example, we're looking at costs. We can see revenue, we can see net income, we can see net income per customer, we can see the cost per lead, the cost of the marketing qualified lead, the cost of the sales qualified lead. We can see things like our cost per customer, users, et cetera, et cetera, et cetera. And ultimately, what you're trying to do as marketers, you've got to get to really understand business intelligence tools like Microsoft BI or Power BI or MicroStrategy BI tools. Once you start to understand how these tools work and how you can use them as a marketer, it's going to change your conversations internally, and it's going to change how you react to financial pressures that marketers often go through. So, 7 reasons why measuring marketing performance is critical. The very first one I like to look at is measurement directs behavior. So when you're sitting down with your executives and you've got a tangible outcome, you can show them what's going on, you can discuss direction as a consequence, and everything is based around your numbers. You're not leaving to oh, it would be nice to do this or it would be nice to do that. We're talking tangible numbers will help us with our direction going forward. A measurement clarifies expectations. It improves business insight. When you can measure and clarify the expectations that others have within your organization, all of a sudden you can improve that business insight greatly. Thirdly, measurement increases objectivity. Absolutely. You know, there are so many people that have a bias around marketing, for example. They believe we're the bunny huggers, that we just do everything, nice little ads and, et cetera, and all we do is spend money. And that couldn't be further from the truth. And the only way that you're going to remove that bias in any organization is to show them objectively what we measure, what our contribution is to the bottom line. Okay, number 4, measurement enables prediction. Absolutely. All of a sudden, as marketers, we can sit down, we can do some proper business modeling, we can do some proper analysis, and you can then demonstrate in boardrooms or in executive committees exactly what your modeling is showing in terms of growth, market share growth, et cetera, et cetera, et cetera. Okay, number 6, measurement increases visibility. It's a direct contribution to the bottom line performance, and you can see it. Everything I've been showing you this evening so far indicates how it alludes to the bottom line and how it contributes to bottom line. And then lastly, management facilitates feedback. Guys, if you can go into a boardroom with a hardcore set of statistics and facts and figures, you have a meaningful voice in the boardroom. And that's what marketers need to achieve, that meaningful voice in the boardroom. And you're talking the same language as your FDs and your CEOs, et cetera, et cetera. And that is what you need to get to. You need to understand these metrics. You need to understand revenue and profitability. And then, like I said to you at the beginning of this conversation, at the end of the day, you need to make sure the FD is your new best friend in the organization. Okay, so ultimately the approach applied in this introduction presentation should serve, hopefully, as a starting point from which you can build a more robust measurement process in your own lives. What you need to do is you need to start incorporating both financial and non-financial metrics in performance measurement to be able to justify the investments and the marketing decisions that you're going to be making around products, brands, and services, both in the B2B and in the B2C sector. These have application right across the spectrum. And I've proven that umpteen number of times. And ladies and gentlemen, that's my story for today.
All right. Thank you, Peter.
You're most welcome.
I once again realize, the argument of a very good friend of mine who is a maths genius. He is, by the way, the headmaster of a private school, but
Okay.
He said he will always argue with me the point that says that maths is the underlying factor in every single discipline in the world. And I think you have just proved that tonight again, and I think you will love you for that.
It's so funny you raise that, because I was one of those students many years ago where it was, I want to be creative. I want to go into marketing. What the hell is this maths going to really do for me?
Yes.
And I learned the hard way that maths is going to do a lot for me. So I better learn how to understand it and how to apply it.
You are absolutely correct. And I just want to make a quick comment here from Jika said, I'm officially intimidated by marketing. Also excited because I have just discovered that marketing is more than just the 4 Ps. Super excited to learn more, I must say. Thank you, Mr. Ivanov. So
you're welcome. And as I say, I will share this content with you, Hank. I'll email it across to you so you can then distribute it amongst your students.
Yeah.
And anybody that wants any further information, they're more than welcome to get hold.
Thank you very much, Peter. I really do enjoy advice there. There's a hand been raised there from David. David, you can just unmute your mic and ask your question or your comment.
Yeah, please do.
Thanks, Hank. Peter, I just wanted to make sure I don't forget the words you said you have learned over years. You said something like you can't measure what you...
Yeah, so the saying goes as follows. And in fact, a very famous business consultant by the name of Peter Drucker actually said it. But he said, what you don't measure, you don't manage. And what you don't manage, you don't measure. And nothing could be truer. If you're not going to measure anything, you're not going to manage it. The reason why you manage your bank account is because you're measuring how much money you got in there. If you think about it, and it's the same with anything. If if it's of value to you, you will manage that process. And likewise in marketing, we tend not to do that. And I've learned through the hard way. I mean, I've sat on a number of listed companies' boards, and I can assure you, when you're sitting in those boards, they're going to ask you the hard questions. And if you don't have the answers, then you're not going to survive. And that's the bottom line.
Yeah, absolutely, Peter. David, thank you very much. And I can guarantee you that there are many, many disciplines at the moment where there are tough questions that's been asked in the boardroom in terms of the return on the investment.
Yeah.
Even in the discipline of human resources currently, people are asking, what do you really bring as value to the organization? And really, how do you impact the bottom line of the organization? All right. Anybody else there for a question? I'm opening up the floor there. Anybody else? Brian, I see earlier your hand was up. I don't know if you maybe have your question or a comment. Rihanna, you can go ahead.
Yes. Okay. So, Peter, every time you race and you talk about the numbers, I just get excited all over again about marketing and how to convince people to, spend their money on the marketing deliverables. But I think what's important for me, what I've learned also over the years, and I want to say to all the people here aspiring to go into marketing or already are in the marketing profession, is that marketers tell me that they feel that they can't make a difference. They feel that that people don't listen to them. But I promise you, if you start talking about the numbers, even if it's just in your space, even if you are just providing numbers to your boss, that is providing numbers to someone else, but you do understand what you're talking about and you can show them where things is going right and wrong, because that's what people want to know in a business is where am I making money and where's things going wrong and how can I improve it? And if you just start with some of these measurements and you show them in a practical way, some people see the numbers, and Peter, I like the fact that you showed the graphs as well. Some people are going to interpret the graphs better, but if you keep on talking to them and you're talking sense and you're talking the numbers, people will start listening to you as a marketer. I can promise you that.
You couldn't be further from the truth. And I remember I had one of our chairmen happened to be from Barlow Rand, and I did a presentation to them using purely numbers on the marketing side, what our customer acquisition costs were like, what our retention rate was like, etc., etc. And I can assure you, from then on, after that first presentation, he always wanted to know exactly what was going on, financially speaking, from a marketing perspective. And I never ever had a problem justifying any particular spend that we required because it was supported with the numbers.
Absolutely. All right. Any other questions there for Peter before we're going to conclude our evening? I think our students has quite a bit to digest here.
Yeah, it may be a little bit overwhelming, I know. But as I say, it's a very large subject, and there's much more that we can talk about.
Yeah, no, I definitely agree. Brian, yes.
Yes. Good evening, Hank. Good evening, Peter. Thank you so
Hello.
much for your insightful presentation. I think this is usually one of the topics that I like, especially when students usually give them a marketing plan to do. So I always ask them, okay, how are you going to check the effectiveness of that campaign? How is that campaign going to contribute to the bottom line? Are you able to prove it? Are you going to look at customer acquisition cost? How much tracking are you going to gain from all these tools that you're going to utilize?
No, exactly.
So I usually like it for that bit, because we check how, if you've invested so much for this particular campaign, I say, Peter, I'm giving you 10 million to do this campaign. How does it contribute to enhancing the organization?
Exactly.
Yeah, that's how I always look at it. But I think from a student's picture, that's how we always do it. Especially even in any company, that's what we always do.
Yeah.
So thank you so much for that. I think I'm seeing that connection.
You're most welcome. Welcome.
Thank you very much, Brian. I definitely agree there. All right. Okay, guys. So from my side, just to conclude, I also just want to share with you maybe just one of the things. I've got a very good friend who works for a company called Buffetti Van Mellon. They are, if you buy Mentos, you will know what I'm talking about. And he's one of the territory developers, and they've recently had a visit there of the international company, which is based in Dubai. And I can promise you that was quite a stressful time for him, because one of the things that he had to demonstrate is how their marketing is actually gaining share in South Africa, is getting momentum in South Africa, what is the real return on that. And that was all about numbers. So I just want to again support here Peter's presentation, that it is not just in his world, but there are numerous evidence of how people use numbers as the key to motivate for what we are doing in marketing.
Absolutely.
Peter, from my side, I would like to thank you for a very insightful and a very, very well-structured presentation. Thank you very much also for your time.
No problem.
I really would like to encourage our students to engage more with this specific topic, for those who have an interest a little bit in numbers, and really see if maybe there could be a potential career for you in crunching those numbers within the marketing field, and not just looking at a 4-piece.
Exactly.
So I would like to say, everybody, thank you very much. Also, our students who attended tonight, guys. David, all right, I'll give you a quick last chance.
Sorry, Hank, man. I just wanted to ask something.
Yes.
Not sure if I missed it. I don't know if our marketing teacher has already sent a scope for the exam.
For which marketing is that, David?
301.
301. Yes. No, it's been done. It will be uploaded tomorrow, David.
Okay.
I will upload it tomorrow on Canvas. All right.
Thanks, Hank.
All right. Okay. Thank you very much, guys.
Bye.
All right. Peter, thank you very much.
You're welcome.
Everybody have a great evening and stay safe. We are in the middle of the week, downwards to the weekend.
Okay. Bye-bye. Bye-bye, everybody. Bye-bye.
Thank you, everyone. Have a good evening.
Thank you, everyone. Thank you. Bye-bye.